What does it mean to link to an index? You need to understand what it means to link to an index instead of having your money invested in an index, because it never ceases to amaze me how many people, including financial advisors, think that an indexed universal life means that your cash values are invested in an index mutual fund. No. You would have lost 40% in 2008. None of our clients lost one dime during that market downturn in 2008 with Indexed Universal Life. Stay with me, you'll understand why. So I'm Doug Andrew, and I've been helping people optimize assets, minimize taxes, and empower what I call their authentic wealth now for 5 decades. And I love helping people understand how to accumulate money tax-free, then be able to access that money income tax-free or turn on tax-free income, where every $1 million that I help them accumulate tax-free can generate $100,000 a year of tax-free income from age 65 all the way to age 120 if they live that long without depleting principal. And it's amazing how many IUL agents don't know how to do that. Okay, so the purpose of this series here is to define some terminology that if you ask an IUL agent the meaning of some of these terms, if they can't sort of answer it, if it doesn't roll off their tongue, that's a red flag. And I'll show you how you can get in touch with an IUL agent who's been certified as a professional. So when we talk about what linking is, so many times I have heard advisors that think they know it all, that think that Indexed Universal Life is a life insurance policy, a universal life policy, wherein the cash values in the insurance policy are invested in an index like the S&P 500. No, that would be variable life, okay? I've never owned a variable life insurance policy. I never will. When I started back in 1974 until 1980, by 1980, I ended up being responsible for over 3,000 clients in 13 Western states, and they had their money invested in the market in mutual funds. They were never happier than when I got their money out of the volatile stock market and I put it over into universal life. And then when interest rates started to come down, even though from 1980 to 1990, they never got credited less than 11.75%. But in the 90s, interest rates started to come down. And in 1997, Indexed Universal Life was introduced. And so many agents do not understand what this is. Okay. Now, in a life insurance policy, in particular, we're talking about universal life. And in this case, Indexed Universal Life. This is what happens. You put your money, your premium into the policy. The actual costs of the insurance are very small compared to the actual premiums if you're maximum funding it. And so if you do it right, you're becoming self-insured. And most of my clients that are 55 to 75 years old, their cash values would grow to equal and exceed the death benefit within 12 years. Now there is no cost for the insurance because your cash value has equaled the death benefit, and now it begins to exceed it. And so if you die, they still pay out a little bit more than your cash value, but it's like buy term invest the difference on steroids. You can't believe how many advisors don't even understand what I just said. But how can you make this perform well? And what does it mean to link to an index instead of being invested in an index mutual fund? You ready? If I had my money in an insurance policy and the insurance company were to take my cash values and invest it at risk in the market, that is called a variable contract. You have to have a securities license to do that. And I've never owned a variable policy. I never will. My clients were never happier than I got their money out of the volatile market. So how does indexing work? Well, if I accumulate, let's say, $1 million of cash value. Now, sometimes people say, well, that's a lot of money. And others say, well, that's not very much money. So let's just, it's relative to your circumstances, but you can extrapolate from $1 million example. Many of my clients who started talking about $500 a month in their 30s ended up with $1 million 30 years later. Most of my clients that are 55 to 75, they put in $500,000 within 4 years and 1 day into a max funded IUL. And now they have 500 grand in there. And then it usually doubles to $1 million within another 7.5 years. So here we are in 11.5 years, and they're 500,000 of cash value is doubled to $1 million, and that was the amount of insurance they started with. And so this thing turns into a cash cow. Well, they could wait and it could double to 2, and then 2 doubles to 4 million, and 4 doubles to 8 million. But anytime they want to stop and take out income, every $1 million can generate a payout of 80 to 100,000 a year of tax-free income without depleting principal. And this is what's happening. You are earning interest on that policy based upon you either saying to the insurance company, hey, I feel bearish about America this year. I think we're headed for a recession. I think the economy is going to go down. In that case, you'd say, you know what? I don't think the market's going to do well. So just pay me the general account portfolio rate. Now, there's a video that explains what the general account portfolio rate is. And with a lot of insurance companies in a low interest environment, it might be 5 or 6%. That's the amount of interest they're earning on their mortgages and their AAA and AA bonds and what have you, conservative investments. And if they were earning 5 and they need 1 percentage point for them, they're netting 4. And so you could settle for 4%. That's 40,000 tax-free interest on your $1 million. When banks were only paying 1, 4 was 4 times as much, 400% more. Now, when interest rates start to come up, the insurance company's general account portfolios go up, but also the caps on indexing goes up. When you feel bullish about America, which 7 out of 10 years in most 10-year periods, the market's going to go up, okay? So whenever you feel like, I think this is an election year or whatever, I think the economy's going to go up, you can link to an index. So what does that mean? Get very clear on this. You are not telling the insurance company when you link to an index, like let's say the S&P 500, you're not telling the insurance company to take your $1 million of cash value and invest it in the S&P 500 index funds. No, your money stays safe in the insurance company, earning, let's say 5 or 4, whatever, okay? Let's just say 5. It's safe in the insurance company earning 5. What are you giving up? How can the insurance company afford to pay you 8, 12, 16% if the S&P goes up that much? They're big boys and girls. They know what they're doing. They wouldn't offer it if they didn't know they could afford it. How do they afford it? Your million stays safe in the insurance company. You're relinquishing the general account portfolio rate. In this case, let's say 5%. You're willing to give up the 50,000 of interest that you could have that year. So they're going to take that interest on your million, that 50,000. They're going to buy upside options in the index that you chose. This is called linking to an index. They're buying upside options in the S&P or the Dow Jones or the Russell 2000, or maybe all of them. You can diversify among all of them, okay? So that means this, at the end of the 1 year point to point, let's say, if the S&P is up 8% over the year before, they'll pay you 80 grand. Okay, how can they afford to do that when they're only earning 5%? It's because you gave up that for sure 5%. They bought upside options because they're off the hook if the market goes down. They don't owe you anything, but you didn't make anything. Okay, but they don't owe you anything. But that gave them the wherewithal to pay you if the market goes up. Those options grow to pay you 80,000, 8%. If the market goes up 12%, they'll pay you 120,000. Based on the price of options and what they do and what you chose, they could credit you 160,000. There's sometimes if you choose a 1 year point to point with no cap, like March of 2020 to March of 2021 due to the COVID-19 pandemic when the market dropped 30%, my sons told some of their clients who had money coming up for linking, let's link to the S&P 1 year point to point with no cap. We normally don't do that because there is no cap, but the trade-off is they subtract 5% off of the top. If it's a normal period and the market went up 12%, you'd only net 7. That's pretty expensive to link with no cap. But when the market drops 30%, it's smart because the chance the market was going to be up substantially was very high, and it was. It went up 66.33% in 1 year from what it was in March of 2020 due to the dip in COVID-19. 66.33 minus 5 percentage points, they netted 61.33%. Where in the world did the insurance company have the wherewithal to pay 61.33% to those clients? One client in March of 2020 had $852,000 of cash value in his policy. They credited him $535,000 tax-free that year. Where did they get the $500,000? Because the options were able to allow them to do that. Didn't come out of their pocket. Because he gave up the interest on that and chose a 5% threshold, and so he was able to not have a cap. See, that's why it's so important to work with an IUL specialist that knows what they're doing so you don't miss out on fortunes that you could otherwise have, which is the title of my first book, Missed Fortunes. The fortunes people miss out on because they don't know what they don't know, and they're working with an agent who doesn't know what he or she doesn't know, okay? And so linking to an index means you're linking to an index like the S&P, the Dow Jones, the Russell 2000, or a combination of all of them. But you're simply taking the interest on the general account portfolio to buy upside options that if the market goes up, the insurance company has the wherewithal to pay you 8, 12, 16% up to a cap. What's the trade-off? If the market crashes, your options expire worthless, but you still have your money safe, the million. You didn't make anything that year, but you didn't lose. And as Will Rogers once said, people get more concerned about the return of their money when things are bad instead of the return on their money. Does that make sense? So if this is resonating with you, I want you to see actual examples and study this. This is my 11th book. It's been flying off of our warehouse shelves. And we send out 1,000 of these a month. You can go to Amazon and pay $20 plus shipping. I'll gift one to you free. So to claim your free copy, I require a little bit of skin in the game. You simply go to laserfund.com, click on the link below, and you contribute a nominal amount toward the shipping and handling. I'll cover the rest of that, and I'll pay for the book, okay? I'll fire out a hard copy to you via priority mail. It's actually 2 books in one this side, about 200 pages are the charts and graphs, the left brain. This is the right brain concepts, the stories and examples. That's about 100 pages, 62 actual client stories. So use either your left brain or right brain or your whole brain to learn about this. But I assure you, if you study this book and you watch a few more educational videos, you'll know more than 99.9% of IUL agents out there. And so here's what I would recommend you do. When you're in there claiming your free copy of the book, you can schedule an appointment to talk, no cost, no obligation. It's a free consultation with a certified IUL professional. Now, what's that? Well, out of tens of thousands of agents that are licensed to sell IUL, I would say that the vast majority, 95% or more, are structured wrong. They don't understand this. And so it's not going to perform the way it could perform. It'll be lucky to perform at 25% of what it could have performed at. And so it's critical you talk to somebody who's certified. So we created a coalition or network to educate IUL professionals. It's called IUL Insiders. Many of them come on for a year, 2 or 3 years, but the ultimate goal for them, as far as I'm concerned, is to have them become certified as a professional. That's a 100-question proficiency exam that is not easy. You have to score 100% before you're certified. Most advisors in this country wouldn't even score 20% because they wouldn't understand 80% of the questions. So I'd recommend, if you want to see how it's done right, that you utilize the services of a certified professional. Now, if you're an IUL agent and you're going, oh no, my client's going to know more than I do, that's embarrassing. I would recommend you check out IUL Insiders by going to IULinsiders.com. You start learning, and I would recommend you get certified because you're going to be left in the dust if you don't.